Good morning, everybody. Thank you for joining us today. Um, as part of iThought PMS team, we wanted to do a webinar on all-weather investing. We wanted to explore what's happening in the market, how investors can think about a strategy that works in every market climate. And that was the intention behind today's webinar. So as usual, we'll follow a very simple format. We'll run the presentation for maybe 30 to 40 minutes, and then we'll have a lot of time at the end to do Q&A. So feel free to drop your questions into the chat box, or if you want to put it in the Q&A section of Teams as well, feel free to do that. And then we'll get through all of the questions one by one at the end of the session. So thank you once again for spending some time with us on Saturday. We hope we're able to add some value to your weekend. And without further ado, let's get started. If you want to know more about iThought PMS, you can just quickly scan this from your phone and you'll get taken to our YouTube page. So we wanted to understand what the investor's dilemma is today, right? Because what we see is that investors constantly keep changing their strategy based on what they think is the best thing at that point in the market cycle. And typically, when you look at the results of what comes from this, there is a gap between the market's return and the investor's return. And that's something that we can avoid. So we thought about what is it that can be one strategy for every market, and that is essentially what we're going to be talking to you about today. What is all weather investing? So the first thing we need to understand is probably to take a pulse check and see what investors are thinking about the markets today. So if we look at the market mindset, you have a lot of investors saying, especially those who've come in the last 3 to 5 years, they sort of come up with this idea of what kind of investors they are, right? So they have this mindset that, okay, I'm a long-term investor. I can stay invested in something for 5 years, and I'm willing to put up with the volatility that comes with that. Or you've had extremely powerful performance in this period. So then there's a new expectation that's built up saying that, okay, I only want the best results, right? I am an aggressive investor. I can handle the risks that come with small and mid cap investing. And I've seen the results, so I don't want to settle for anything less. And over and above all of this, where you've had a really good run in the markets, you've had very good performance, and you've been able to make returns as a very aggressive, with a very aggressive style of investing. You also have something that is the India story, which is that anywhere you go for the last 2 years, all you've heard is about the India story, right? So we have this huge demographic dividend. We're doing much better than global peers on growth. At the same time, we've had all of these policy reforms that are pushing in. And so you are seeing a change in India, and then there are a lot of positive sentiments. So even on the macro front, we're doing really well because our inflation is getting under control. We've not really spent too much during the pandemic, so we don't have any of that excess policy unwinding that's happening. At the same time, we're on this very good path of like fiscal consolidation. India has gotten included into the global bond indices. We're up. We could be up for a credit rating upgrade in a couple of years' time. So all of these positive things are only adding to the context that India could be a great place to invest, and that you should keep the faith and be optimistic about what is going ahead. So, at this point, as investors, we really need to take a step back and maybe think about how we want to process this information and whether we want to look at some of our assumptions again, right? So we need to ask, what if the weather changes? What if it's not a sunny climate for India and it's not a sunny climate for the world? What if we're actually at a phase where, global growth actually softens a little bit? And this is not far off from where we are today, right? Just a couple of days ago, you had the Federal Reserve cut interest rates for the first time in 4 years uh, to almost by 0.5%. They're talking about unemployment So despite maybe a 1.5 or 2% rate cut that's going to happen uh, cumulatively in 2024 and 2025, you're still going to see unemployment in the US at the same level. That's what the Fed is expecting. So, despite all that heavy lifting that the policymakers are doing, they are expecting unemployment to stay at the same level, which means that if they don't do enough, or if they're unable to do enough, then you're going to have a more difficult or more challenging macro environment. When global growth softens, you could also see FII sentiment change, right? And they might move towards safe haven assets. And this could mean FII monies flowing out of India into the dollar or into gold or into other things. We're already seeing many central banks sort of load up on gold, primarily because of certain geopolitical tensions, worries about like how currencies will move relative to each other, and from a diversification perspective. So, if you're looking at how India is positioned as an economy, if global demand softens, that is, if you have a global recession, if you have those kind of things, even if it's not a very deep or like a crisis-oriented one, we need to understand that in recessionary periods, demand softens, which means that a lot of your export-oriented things or your make in India or your manufacturing, that could also take a slow beating, or you could see some contraction in those activity parameters. At the same time, if we listen to closely to what the RBI is saying, yes, we're very much on track for our growth target. We're very much on track in terms of managing inflation so far, but it's not like risks to inflation don't exist, right? That is something that is definitely keeping the RBI on its toes. That's why you're seeing also our system liquidity has been in deficit, while our interest rates have remained at the same level. So inflation is still a cause of concern, and it's not something that can easily be solved just by pushing or pulling your interest rates. You have had a lot of supply side interventions that have occurred in the last 2 years, which has helped keep inflation at this level. And all of us know from a very practical perspective that while your inflation numbers are reading at 5 and 6%, households are spending way more than 5 and 6% than they were a few years ago, right? So when all of this occurs, there is a chance that this could cascade into corporates also missing their earnings estimates. And when that happens, you can have valuation re-ratings, you can have time corrections in certain stocks. So basically, you can have the market then change its risk appetite and become risk averse. So at the individual level, an investor may still be confident and may still be optimistic, but the market may change its mood at any point. And then we really have to ask ourselves the most important question, which is, will equity still be a safe place for an investor at that point? You can be aggressive, you can be long term, you can want the best returns, but this is a question we need to ask ourselves, because clearly there are some early shoots of sort of challenging the existing narratives that are there in the market and opening up the doorway for other stories to play out. So, as investors, we need to be aware of what these other stories are and see if we need to look at a more robust strategy that is going to work regardless of which door opens up in front of you. So let's take a quick look at the history of investor behavior, because I was talking about how market sentiments can change. So what tends to happen is when there is enough performance or when there is consistent performance over a few years, investors start developing confidence, right? And that means the level of buying actually increases, the level of conviction actually increases, and the level of participation increases. And this goes on for some time, and it can go on for longer than we expect. It can be shorter than expected. But essentially, there is a lot of faith and confidence that's driving investments rather than fundamental factors or actual performance-related metrics. But then, as always happens, the cycle will eventually turn. And then, instead of confidence, what tends to happen is fear tends to build up. So, you can only guess what the outcome of such behavior is going to be. And when the markets don't act rationally, you want to be on. You want to have a separate strategy that's not going to be affected by what the market is doing, right? You want a strategy that's going to give you a positive outcome, regardless of how the market actually behaves. So just to look at performance chasing and why it's not a great strategy, this is data that's come out from Bandhan Mutual Fund, and if you look at their multi-asset product, they actually have this data available there. So let's take a quick look at what this is. So assume you have 4 years, W, X, Y, and Z, and you have 3 asset classes, A, B, and C. Now in year W, A is the best performing asset class. In year X, B is the best performing asset class. And in year Y, A is again the best performing asset class. And in year Z, C is the best performing asset class. So if you look at how investors behave, in year W, most people are not participating in asset class A. But once you see that performance, you see investors move towards asset class A in year X. Similarly, in year X, nobody is looking at asset class B because it hasn't been the best one in year W. And then they shift their money to asset class B in year Y after you see performance. So this keeps repeating, and basically investors choose to perform in whatever the best performing asset class was of the past. Now, if you do an equal weighted strategy or a performance chasing strategy, this is the data that Bandhan has come up with. There's almost a 1.5% difference in compounded returns over a 13-year period. And that's a huge difference, right? Because you can see this 1 lakh when you're performance chasing becomes 2.3 times, and that means it's grown 2.3 times over 13 years. Whereas if you did an equal weighted, that is, you're not even trying to guess what the best performing asset class is, you just rebalance and you adjust your portfolio, then you're at 2.7 crores, right? Which is 2.7 times. So that zero point 0.4 factor that you're compounding or that you're multiplying your money by is actually missing when you chase performance. And this is what happens to investors. This is what explains the gap between how the market performs and how an investor performs. The idea is that you need to have a strategy that works in all conditions. So we must remember that people will always be people. You have a choice today because we're having a conversation that we shouldn't be chasing performance. But most people are going to chase performance and they're going to think that no, you know what, this time it's different. I'm pretty sure that we've had a really good run in one segment of the market, and there's no reason for us to assume that this run has to end because this is India's decade, and it's not just India's decade, it's like, right up till 2047, like, we have 100th year and of independence and all of this. So there's a lot of narrative that's fueling this, and it's difficult to convince people with facts when there are stories in front of them, because stories are a lot more compelling and stories are easier for us to understand. So to do that, to counter this narrative of stories, I wanted to take a few examples and show everyone today that anybody can actually lose money in the markets, right? And this will counter everyone who's telling us that they are long-term investors, that they are, very capable of handling the ups and downs, that they're aggressive, that they want the best returns. Anybody can lose markets. It doesn't, I'm talking about experienced investors, I'm talking about new investors. Everybody is capable of losing money in the markets. And we'll take a look at a few examples of what I mean. So, India, two cases where long-term investors have lost money. Right, this is the Nifty between 1997 and 2003. You want to take a wild guess at what this return was over that 6-year period? Yeah, investors on a compounded level lost almost 1% in the market during this phase. You did have good years of performance. So if you look at the segment between 97 and maybe 99, 2000, you had a really good run in the markets. Then you had your dot-com bubble, you had markets correct, come back, and then sort of flatline, right? So you can have phases where there's no performance, and you can have phases where there's good performance. So what does this teach us? When you're seeing good performance, it's not that the next phase is going to be bad. Markets are volatile. You'll have good years, you'll have bad years, even between years where it's flat. But you need to book profits, and a lot of investors are not actually focusing on booking profits. I'll quickly walk you through another example in India where investors have actually lost money in the long term. Again, 2008 to 2013. Yes, 2008, 2009 was your crisis, and if you had um, invested then, you would have basically experienced a very good run up until 2007 8, right? And then you had your sort of downward trajectory, and here also investors lost money, right? You made a flat negative 0.75 compounded return between 2008 and 2013, which is again roughly 4.5 5 years of investing. So it's not that markets can't enter into time corrections, they do. And it happens often, and we should be aware that it happens because, after all, we are making decisions about wealth creation. Well, it's not just India, even global markets can be a tough place. And I'm talking about the world across. So if you look at between 2000 and 2005, again, a 5 year period almost in the markets. And this is all countries across the world. It's not a specific country. You have large and mid cap. So across different market caps, across different countries, you've made a flat return less than 1% on a 5 year basis. So there are phases in the market where people can lose money. And not just that, other asset classes also can give you a situation where you don't make money, and even gold can lose its shine. So up until if we look at data between 2011 and 2019, that's like a good 8 year period, year or 7.5 years in this case, because we're starting the end of 2011. You really don't have much of performance from an asset like gold. So this teaches us that commodities are actually cyclical. You can have long phases of no performance, you can have long phases of performance, and investors need to know which phase we are in. And this is why multi-asset investing actually works, because you need to have an overall strategy where you're participating across the board and you're able to capture these opportunities when they're cyclical. So this is one of our favorite quotes from Warren Buffett, where he says, there are two rules to making wealth, and rule number one is that you never lose money, and rule number two is that you should never forget rule number one. And we are in a market where everyone has forgotten rule number two, right? Nobody is thinking about how they can lose money. Everybody's thinking only about what's on the table and what's left for them and how they can participate more and how they can ensure that they're making wealth continuously in the future. So, because we're not looking at the different ways in which we can lose money, a lot of us are ending up taking more risk than we can handle. And we won't know this until rule one materializes, right? Until we actually lose money in the markets, we're not going to be able to recognize that we've forgotten rule number two. So this is the investor's dilemma, or even your dilemma today, which is you want to save regularly, you want to avoid losses, you want to compound in a very consistent manner, you want to be investing at the right time, and you want to be investing in the right places, right? It does seem like this is a lot to ask for, because uh, how are you going to make sure that you're compounding consistently, or that you're investing at the right time in the right place, when there are so many things to choose from and there are so many moving parts, especially because today, even if investors have been listening to caution and in the last 1 year they've taken money off the table, you've seen the market move up. And that can cause a lot of buyers, or rather sellers, regret at this point, because you would have thought, okay, if I had waited a little bit more, then probably I would have still made more money in the markets, right? And that is not going to go away. Unfortunately, investing is tough. You are going to feel like you didn't make the right decision, and you're not going to be validated immediately, but you have to wait, and you have to manage. So we came up, or there is a simple solution to all of this, which is How do we solve this dilemma? It's the simple solution is through asset allocation. So make sure that you have a variety of things in your portfolio. We showed you some data at the start of this presentation on how if you have an equal weighted portfolio, that's a very simple strategy, right? You're not even trying to curate anything more than that. You're not trying to layer it with any judgment or intelligence. If you just have an equal weighted strategy, then that itself is going to do a world of wonders for you. And this is another data point that we actually wanted to talk about, which is there's a really interesting study on what actually, if two people invest at the same time, what is it that contributes to the difference in their returns, right? So what is, which is simply saying what are the determinants of portfolio return variability. And when we look at that, most people think that, what's going to make a difference is the stock that they pick or the time at which they invest in the market. And that is where a lot of energy and focus goes into. It goes into deciding that, okay, markets went up today. Should I put in money or should I wait for the next correction? Or it goes into, okay, what is this person buying? Let me see. This fund manager got this stock. Maybe this is the stock that I need to add to my portfolio. But when you really look at what is causing the return variation, right, it's not either of these things. Security selection, that is choosing the right stock and timing the security selection matters, maybe explains maybe 5% of the returns. Timing the market explains even less. It's less than 2% of the returns are explained by the time at which you invest. But 90% of what determines whether you're performing better or worse than someone else is your asset allocation. And honestly, let's take a moment to reflect and think about how many of us have actually spent any time studying our asset allocation or preparing our portfolios at an asset allocation level and deciding that, okay, this is something that we want uh, to balance out. This is something that I need in my portfolio. Many of us don't dedicate our time to the thing that is actually going to explain the most difference in returns. So if you want to outdo the market, if you want to outdo somebody else, then you need to focus on asset allocation because that's where whatever effort you put in is actually going to result in something. Security selection does matter. Timing the market does matter, but it doesn't matter as much. So why does asset allocation work? Okay, this is a really interesting chart, and how you're going to read this is we have data from 2010 to 2023, and this is calendar year wise data. So at the top you have the best performing asset of the year, and at the bottom you have the worst performing asset of the year. So if you pay attention to this graph, what you'll notice is nothing stays in the top three positions for more than 3 years at a stretch. Yeah. At the same time, nothing is at the bottom forever either, right? And you have winners becoming losers very quickly. So if we look at small cap, let's say 2015, 16, pretty flat, right? For such level of aggression, 1%, 2%, 5%, 6% returns. And then you have 2017, where you're making almost 60% returns on this particular category. Then you have 2 years of no performance, 2 years of brilliant performance, 1 year of negative performance, and then another year of brilliant performance. And you're still seeing performance in 2024. Similarly, you look at an asset like gold, 2010 and 11, you did really well. Then even in our other chart, we saw, right, that you had almost no performance in gold between 2011 and 2019. So you see that you lost money in 2013, then you recovered some of it in 2014, then you had a negative drawdown again in 2015, then some positive returns in 16, 17, and then you finally start seeing performance around 2018, 19. So when you look at this, you realize that something that's a winner can easily become a loser, something that's a loser can easily become a winner, and we shouldn't make judgments on one segment alone. We need a little bit of everything. The third and most important thing is you can have one or two losers in a year, but not everything is going to lose, which is why multi-asset investing is really important. Because of course, if your entire portfolio is concentrated in one asset class, there are going to be ups and downs in that one asset class, whether you look at equity as a whole, whether you look at it as small, mid, and large, however you want to divide it, or if you look at fixed income as a whole, or you want to separate that into, government securities, credits, and corporate bonds. All of this, it doesn't matter whether you're looking at sub-asset classes or overall asset classes, you do realize that there's no year where everything is going to give you a negative return, but definitely there are years where some asset classes give you negative returns. So our top three takeaways. No years where everything fails. At least half of the time in the last 14 years, all asset classes have delivered positive returns. And I'll just quickly go back to this chart and show you that 2023 was one of those years, 2020 was one of those years, 2017, 2016, 2014, 2012 and 2010. All of these have been years where you're having positive performance in every asset class. So the idea that, oh, if I add something that is lower risk, like let's say fixed income to my portfolio, I'm not doing myself justice, doesn't actually make sense. And that's what is actually going to help us cultivate resilience when we're in tougher market phases and when the climate changes. If you have lower risk assets in your portfolio, your losers can actually become winners and give you that liquidity to create another set of winners for the next cycle. So finally, I want to get to what we do at iThought. We also run a multi-asset portfolio management service called Sphere. And this is where we like to think the magic happens, because we've got very happy clients who've experienced really good results with Sphere in terms of how comfortable they are about or how confident they are about managing their financial commitments, how comfortable they feel during retirement, how they're happy with the wealth creation, and they've not had to really compromise on this whole risk reward scenario. And you'll actually see our portfolio performance in some time. So just a quick thing of, okay, what makes Sphere different from other multi-asset products in the universe? So one, when we look at multi-asset funds, let's say in the mutual fund space, they do have allocation limits. They are at some level more tax efficient, and because they have a higher allocation to equity. But most funds have very vanilla ideas in terms of asset allocation. When it comes to what we do at Sphere, there's a lot more investment flexibility, which means that I'm not mandated to have 65% of my portfolio in equity because I want a certain tax outcome. We are very tax conscious, and I think this budget has actually helped multi-asset investors, because now you're at a more level playing field on many multi-asset ideas. We have a lot of out of the box thinking. So, we're able to play sectoral calls in the portfolio through a variety of instruments. We're able to participate in global markets. We're able to do very good value and contrarian investing in multi-asset investing. So I think this is what really makes Sphere unique. And of course, high performance is delivered. If we look at our since inception returns, it's almost 25%. Our 2-year returns are about 30%. Our 1-year return is 40%. These are not, by the way, return numbers that we want to anchor investors to. These are just what we've been able to perform. A general multi-asset strategy, I think you can expect anywhere between 12 to 15%. And today, definitely our tone is to move away from performance towards risk management, and that is what we feel is the need of the hour. And if we look at our drawdown metrics, how have we done in a bad market? This data is as of August 31st. Our biggest drawdown has been about 11%. At the same time, the multi-asset index drawdown was about 8%, and a pure equity index like the Nifty had a drawdown of 16%. Historically, we have had a higher weightage towards equities, which is why we're also benchmarking against a pure equity index like the Nifty, right? Then just to walk you through our performance, again, here it's been anywhere between same numbers. We have outperformed our benchmark by a large margin. This is also our current portfolio allocation at the scheme level, right? A new account is definitely going to have a much lower allocation towards equities and more allocation towards other asset classes. So this is broadly like one segment of what we have. These are our basic terms of investments. We are a SEBI registered PMS, so the minimum allocation, the minimum investment ticket by according to SEBI regulations is 50 lakhs. We are benchmarked against a multi-asset index. We run a very simple fee structure. It's 1.5% per annum, and then that is charged on a quarterly basis. Over and above this, we would recommend investors to come in with a 5 to 7 year mindset. That's when you can benefit from these cycles. But we do not have an exit load, which essentially means that if somebody wants to exit earlier or if they want some cash flows from the portfolio, as long as we're within SEBI guidelines, we should be able to provide that without any additional cost to the investor. We have a very flexible mandate, like I said, where our asset allocation to equities, mutual funds, ETFs, any of these things can be anywhere between 0 to 100%. Historically, we've had a higher allocation towards equities. In this market, we would like to temper that. We would prefer to participate in less riskier segments of the market. And there's a whole team and there's a whole universe. In addition to what we do at Sphere, we have three other PMS products, Solitaire, True Blue, and Vriddhi. Neo is also a multi-asset strategy, which is run specifically for NRIs. We have a wide team in terms of we have a good research team, we have strategy, we've got fund managers, we've got our CIO and founder, we've got an investment management team. So there are a lot of people who are within this space working towards better outcomes for investors. And I know that by the end of this presentation, we have talked a lot about multi-asset investing. We've talked a lot about playing it safe. And there are still going to be a few people who forget rule number 2. And maybe if you don't remember everything else that I say, if you can just keep this in mind, that if you do find yourself in a difficult market, or if you do find yourself in the wrong products when the climate changes, please know that it's still not too late for you to change your strategy and move to something that works better in all market conditions. And so with that, I'll open it up. Why don't we have a conversation on whatever you want? This is our QR code. So again, if you have any queries, you want to know more about what we do at ithoughtpms, please quickly scan this. It will take you to our YouTube page. And these are our coordinates. So if you want to ask us anything, you want to get in touch, you want to start your investments, please feel free to write to us on WhatsApp at 9500027285, or you can just email us at pms@ithought.co.in, and we'll be happy to get in touch. Okay. So with that, I'll open for Q&A. Please feel free to type in whatever you have in the chat. I already see one question coming in. So hi, I'm 52. I have a corpus of 75 lakhs. Only I don't have any other investments. For me, is PMS suitable, or is are mutual funds suitable? Both work. So if you're 52, I would assume that you might have another 3 to maybe 8 years before you retire. Ideally, at this point, if we start planning your retirement corpus, it's better to have 7 to 8 years. In which case, I would definitely think that a PMS will suit you more, uh, because you have time to compound, you have time to build some liquidity outside of that. If you're looking at a much shorter timeline, let's say a couple of years, then we need to really see what is the withdrawal that you need, right? What is your monthly requirement? We need to do some math. We have a very good team with respect to financial planning, and they can actually sit and work with you on your retirement numbers and tell you what is the corpus you need to have, right? Or how much income we can provide in that 75 lakh corpus. So that's the basic idea behind this. But if you have a longer investment horizon, then I would definitely encourage that you start a PMS now. Don't delay it. We're in a very good phase for that to begin. If you have a shorter timeline, then please do some level of financial planning before you make any investment decision, whether that is PMS, MF is secondary, but you should know your retirement corpus, what it can do for you, how much you need to save, and other some basic math, right? I think that's very important. Um, okay, next question. With flexibility from 0 to 100% in every asset class, how do we ensure it stays as a multi-asset investment? Okay, I think, see, 0 to 100 in terms of a mandate gives us that flexibility. But to be very honest, uh, there are very few market contexts in which you can justify a 100% allocation or is to a particular asset class. 0% allocation, yes, maybe let's say an asset class like equity. In what scenario would I go to 0%, right? Or if I was looking at an asset class like cash, right? In what scenario would I go to 0%? Like I would always want to have some basic level of cash, right? Whether it's like at least like 1, 2%, 5%, or more. I think you need to be in a very, very extreme scenario, like to not have any exposure. Yes, it's just part of the mandate, but it doesn't mean that you will have only one asset class in your portfolio. The idea is that, see, we are not aiming to be the best or to deliver like the highest return, right? I think that is where we need to look a little more at our fund philosophy. I'm not trying to be the best at something, so or like I'm not trying to give the highest returns. We are trying to do create an investment process where the investor is comfortable to participate continuously, where they experience less volatility. You saw our drawdown metrics, and where they experience good performance. Because if we're able to get these three things, at the like in the middle of the presentation, we talked about the investor's dilemma, right? Where you want returns, you want to compound, you don't want to make losses. We want to do all of those things. If we want to do all of those things, we definitely have to have multi-asset. We cannot do it with pure, uh, you know, just one asset class. You will have ups and downs. You will not have the benefits of under correlated assets that kick in. So I think we are committed to running a multi-asset product. We will do it to the best that the market allows us to. But I don't see us going to 100 or 0 in any asset class without good justification. And those are very extreme anyway. Okay. I am 26 and I earn only around 30K per month. Will PMS work for me if I am planning for asset growth, or should I stick to MF? MF works. You can earn, see, like I think you can compound comfortably at 12 to 15% through mutual funds, right? It's not that you need to do something more aggressive. There's a huge, I don't know, perception that, oh, mutual funds cannot do what other things can do. But mutual funds, you have a whole universe there. In fact, I think the opportunity for multi-asset investing is great in mutual funds because you get exposure to the same themes, right? You get arbitrage, you get global funds, you get gold, silver, whatever other asset classes you can think of. Sectorally, you can participate in different things through sectoral and thematic mutual funds. You can also have like a safer uh, strategy if you want to participate only in blue chips, or if you want to do flexi or multi-cap kind of strategies. You have the whole world there. Uh, you can always build and then decide when you cross that 50 lakh milestone. So we run a program for young investors called Milestones to Wealth, where we take them from wherever they are to their first crore in savings. And just because you cross the 50 lakh milestone doesn't mean that you need to shift from mutual funds into PMS. That is completely the investor's call. I think you can compound very well using products like mutual funds. You can do that in the PMS as well. It's really your choice. Sphere is only multi-asset, but our other products, let me just quickly go back to that slide so that you can all see this. So Solitaire is our flagship fund. It's been run for the last 5 years. And Solitaire is a flexi cap strategy. True Blue is only pure large cap. It's a true blue chip portfolio that is for investors who are slightly more conservative, want equity exposure, but want only the best of the best and the bluest of blue chips. That's who Sphere is a good fit for. Vriddhi is our small and mid cap strategy. So for a young aggressive investor who's looking at those kind of I mean, if you're looking at that sub-asset class, then you have Vriddhi that serves your small and mid-cap investors. Okay, to answer the question on churn, see, we have a very different approach to investing, which is that we gradually participate in markets. So for from a churn perspective, because let's say when an investor starts, I might have some money in liquid, and then that slowly gets transferred into other asset classes as and when the opportunity arises. That churn metric will be higher because there will be selling and buying in the first year. But in terms of portfolio exits, it is only in this market that is. So last year we did about 3 exits in our multi-asset scheme. This year we've done some trimming and some few exits. Again, because we feel markets and valuations have run up and we want to protect investors and we see opportunities in other asset classes as well. So I think this year maybe our total exits have been probably 3, and then we've done some level of trimming at the portfolio across certain asset classes. I hope that answers your question. If you'd like more details on the churn metric, could you please drop us a message on WhatsApp and we will get back to you. I've left the WhatsApp number on screen as well. Okay, I am 24, earning 20K per month now, looking to invest maximum number of savings because moving further, percentage of my investment will decline. Where should I do now? I would recommend that again you drop us a message on 9500027285 and ask for the Milestones to Wealth program. So if there are any young investors in the room, you're in your early 20s or your 30s, you want to start, you don't have the 50 lakhs to do a PMS, but you want to get to like a crore in financial savings, you're very keen on working on your savings, join the Milestones to Wealth program. You're getting a lot of hand holding. We help you with product selection. We will help you with setting the milestones, moving from wherever you are, breaking up this 1 crore journey and making sure that you succeed in this over a period of time. So I think in terms of where you should invest, there is a certain process that we follow. We try to understand what your goals are, which milestone we should work towards at this point in your journey. And we'll also look at your risk appetite and these things. And based on that only, we'll help you select the products. For us, the place that you invest or the product that you choose is the final step in the entire process. We need to understand you, and this is worth a one-on-one conversation. It's not something that we can have on a webinar like this in a public forum. We should understand you before we're able to help you, right? So we don't have 75% allocation to cash. We have, I mean, if you're referring to that chart, that 70% is actually equity. That's the scheme level. But if you're asking about generally what are the instruments that we use when we're looking at cash, then you have ETFs as well as mutual funds, that is your liquid money market, that category of mutual funds. Sphere is suitable for a middle-aged working professional. So again, what you can do is maybe we can help you take a risk profile test. We can help understand what your wealth creation targets are and what your expectations are, and then we can find the investor product fit. Like I said, that must be the final step in our decision-making process. We can contact you after the webinar and try to see what would be the best product for you. Sphere is great. It tends to suit a wider range of people because From a risk perspective, it's slightly lower on the risk side. From the return perspective, it is definitely doing well on the return side as well. So it's not, I mean, typically, if you tell someone to take a low risk product, they expect that they have to tone down their return expectations. We are not in that kind of product, so it actually tends to suit a wider range of risk profiles. In Sphere multi-asset investment, generally how much will be in cash? The cash component changes as the market also changes. For example, today you might be higher in cash when the market corrects. That is, let's say on a day like June 4th, we would have been much lower on cash because we would have deployed money in the equity markets. PMS demands 50 lakh ticket size. Why don't you run a small case to cater small investors like us? Stay with a minimum ticket size. We work with small investors. We just do it through mutual funds because we think it's a much better way for us to work with small investors. And you can start with anything. Our entire Milestones to Wealth program, we have people who are doing 1,000 rupee SIP also there. It's not that it's only to large investors. The idea is that we believe that everyone can get to 1 crore in savings. They just need some guidance and handholding and product selection. We don't think that you have to do this only through stocks. That's not our philosophy or our mentality. How do we shortlist your companies like low debt, etc.? We shortlist our companies. We have a very robust research team. So our basic philosophy across the firm, that is whether this is a mutual fund research, whether it's in any of the PMS schemes, in all of that, the basic philosophy is that we like to be value investors and we like to be contrarian in our choices, which means that will show up in all of our investment thesis. Uh, we pay attention to corporate governance standards. We prefer companies without too much leverage. That is across all schemes. We prefer clean balance sheets. We prefer growth visibility. Right now, what we are liking, we are seeing relative value in large caps. So select blue chips are actually coming at better valuations than, say, their more aggressive small and mid cap peers. So all of this goes into our philosophy and selection. Given that this is a multi-asset product, we also pay attention to macros and we do some level of top-down investing, which helps us choose different asset classes. What is NEO? NEO is our multi-asset portfolio. It is basically for NRI investors. We try to give the same kind of experience in multi-asset investing to NRIs as well. In Sphere, we are running more than 500 crores today. That is our AUM. As a fund house, I think we're closer to 3,000 crores, or we're at least above 2,500. If anyone else has any other questions, please feel free to type it in and we can probably chat about this. Those of you who have asked questions about your portfolios, please do write to us at 9500027285 on WhatsApp. If you just drop us a message, we will have someone from the team talk to you today while you're free and we can take this forward. Do you think today's market is overvalued? Yes, I think as a house, we are a little cautious about valuations at the broad level. We do see select value in particular securities. It is difficult. It's not that we feel that, broadly there are a lot of opportunities. We are being a lot more cautious. Of course, we are also working for the investors, so we need to be very confident that what we're doing is the right thing. So yeah, I think if you're following any of our channels on YouTube also, you would know the chances view is that we need to be a little bit more cautious about how investors are behaving in the markets today. And we need to be careful about deployment. That has always been part of our philosophy. With your expertise, why don't you run a mutual fund first? I think you can ask Shyam this question. I can't answer it. But there are lots of good products. I mean, jokes apart, like there are lots of good products in the mutual fund space itself. That's why we have multi-asset investing, right? That's why we are being more cautious about uh, booking profits. That's why we're looking at maintaining liquidity, preparing investors. See, all of these conversations actually help our investors as well because they understand what we are thinking. They know that if we are encouraging them to lower their risks in their portfolios now and to create liquidity, then they will be prepared to participate also when that time comes. Market is now acting irrational. We know, my friends, everyone is telling to use option right now and earn and take money. What is your view? See, it depends on how you want your journey as an investor to be, right? We like stress-free investing. That's our basic philosophy. I don't want to put in money and then worry if there's a correction, do I take it out? I want to do something that I can consistently do, which will create wealth for me. That is our basic philosophy, and we know that a lot of investors actually prefer to invest like that. Very few people like to do this, very active and like hands-on kind of investing. A lot of people who are investors prefer to just not be bothered by what's happening. And if that is where you are, then I think you should look at a product that will allow you, or you should look at a distributor or advisor who can give you that kind of experience. If you, on the other hand, if you know that thrill and all of that is very important to you, and you feel like you have the bandwidth to do all of this and that it's going to create wealth, then yes, then you can get into trying to use this window for however long it's open to create wealth for yourself. You can definitely, so how to execute an all-weather portfolio using mutual funds? Please get in touch with our Milestones to Wealth team. They are doing the same thing there for investors. They will help you execute an all-weather portfolio and you can do it with mutual funds. There's no need that you have to go to another product or another level. How would you identify a bear market? I wish there was some indication. I think, I mean, you will see some slowdowns, right? Like you don't know what is going to come first. Like either you might have economic data which comes in and then the market will react, or the market may react ahead of that, expecting economic data to be bad. Then you'll have some prolonged period where, your activity is not good, your estimate revisions happen, flows into markets will reduce. So there'll be like a whole bunch of things that happen. It's just that you don't know what sequence it's going to come in. That's the only thing. And I think that will be the basic this thing. There's no formula for what is a bear market, right? So if someone has been late, that's not an issue. I think so. This video is not live on YouTube right now, but I think it should premiere over the weekend on our YouTube channel. And again, the QR code is here. So if you just quickly scan it, you can follow or subscribe to our PMS channel. And when this recording goes live, you'll get a notification. So if anyone else wants to come back and like watch this video or like refer to certain sections, you can still do that. You can go follow our page, subscribe to our channel, and then when it premieres, you'll have access to it. If you want to visit any of our older webinar recordings, then I think that is also available on the channel. Well, I mean, this trend is something that concerns us as well. Uh, it's not going to end very well whenever it does. We don't know when it's going to end, that is for sure. Current markets are unpredictable, valuations are going to go up, and people are very confident. We talked about the market mindset right at the start, right? Like you have people thinking that they are long-term investors. You have people thinking that there is a lot that they can tolerate certain levels of risk. Many people don't know what their real risk appetite is. That is the real problem in this market. If people were more aware, right? Like it's just a very simple thing. Like you can come, you can do a risk profiling test with us and know what your real risk appetite is, right? But sometimes even the test is not accurate because a lot of times we think we can handle things differently. But when we are in that scenario, we react very differently. And I think that is the basic issue in today's market. Yes, there's liquidity. Yes, there's this. But the real problem is that people don't know what their real risk appetite is. And in such a scenario, they are going to find out in not a very pleasant manner. That's also why we had this topic for today. Thank you. Okay, I see people are leaving and we're very close to 11 a.m. So I just wanted to thank everyone for coming today and participating, asking questions, listening throughout the session. Thank you for spending time with us. If you'd like more things, reach out to us on WhatsApp or follow our PMS page. You can leave your comments on any of our videos or webinars. We'll be very happy to help you with whatever you want going forward. We are committed to working with all investors. So even if you're not a PMS investor, please know that we have a program for younger investors or smaller investors. We want to help you think bigger. Please do get in touch. And thank you, everybody. I'll stay on for a couple of more minutes. So as and when there are questions, I'll just respond to that. Yes, so please follow our channel on YouTube, subscribe to it because this webinar is not live on YouTube at the moment, but it will premiere on YouTube over the weekend, so you'll get a notification as soon as it's live on our channel. The program is for young investors is called Milestones to Wealth. We are very active on YouTube, Instagram, and Twitter. So and that content is available in Tamil, English, and we're also starting out in other regional languages like Hindi and Malayalam. So you can follow any of these channels based on what language you're most comfortable with, and you can get in touch with us. If you just give me 1 second, I can try to find uh, you know the link to Milestones to Wealth, and I'll put that here as well. I've just dropped the link for Milestones to Wealth that is open to anybody who wants to participate. Our YouTube channels, just give me a second. Mudalita Kalam is Tamil. Uh, Milestones to Wealth. I've just dropped the names of all of our YouTube channels in the chat. Okay, thank you everyone. I think there is another webinar that's happening from our PMS team on corporate India right now. So I'll take leave of everybody. If you all want to join into that webinar, again, feel free to write to our WhatsApp team and they can send you the link or the recording.